Are you in the camp that's happy the Fed's out of the way, or in the camp that's worried about what they're worried about?
I probably would prefer to be talking about better growth than Fed, if you like, dovishness. But that could change over the next few months as well. We're still kind of suffering from some weak trends associated with trade-related issues that kind of boosted some activity last year, and we're seeing some of the falling off of that. In addition, some of the uncertainty in Europe that's been prevailing, partially because of Brexit, but also some of the political considerations there. So those are reverberating back a little bit. But yeah, I probably would prefer to talk about faster growth.
Yeah. Is this yield curve thing the real deal?
Well, we have to worry about it inverting. We haven't yet inverted in the traditional way, but when we do, it's usually a 12 to 15 month lead indicator for economic weakness. So it wouldn't necessarily mean the markets would sell off today if we did do the inversion, although again, some fear in any given days is likely to have some minimal impact. But in terms of real economic impact, it would probably be somewhere mid next year. The other thing people tend to look at is things like, did we have peak PMI numbers back a few months? And again, if you look at that one as an indicator, it's kind of a 2 to 3 year lead factor on the economy. So that's not necessarily an immediate kind of phenomenon either. But nonetheless, there is data that would suggest a bit of concern is appropriate.
So, Tobias, now that we've reached 5-month highs and sort of wiped out a lot of the sharp losses of last year, you've always got a good feel on sentiment and where people are positioned and where that takes us next. What are you seeing right now?
So we track something, and Sarah, you're kind of right on the nose on this one with regards to our panic euphoria model being a pretty good sentiment indicator with regards to positioning more so than how people feel. And it actually dipped a little bit on this Friday. We update it every Friday. It dipped a little bit from last week, despite the fact the markets were higher. So investors are still pretty skeptical about this rally. They don't really believe that it's totally appropriate. And I would say even discussing with investors on kind of one-on-one meetings, either directly face-to-face or over the phone, we keep hearing this kind of skepticism prevailing, this kind of, it shouldn't have moved this quickly off the bottom. And it just suggests to me that the pain trade's probably somewhat higher.
Higher for how long?
Well, it's a good question. Our sense is that it's more of a first half rally and a second half give back, in the sense that earnings expectations have come in pretty significantly for the first half, where there's greater visibility for management. So they will tend to try to kind of underpromise and overdeliver. That you have a better chance of being rewarded. If you overpromise and underdeliver, all you do is get punished. So from that perspective, I do think some of the estimate reductions we've seen, they've thrown in the kitchen sink, and we potentially have upside surprises in the first half, bringing the market up to as high as 2950 on the S&P. And then our year-end target of 2850, we kind of drift lower as the expectations for the second half are higher. And one last point on that, one of the things we track really carefully is the Commercial and Industrial Lending Standards Survey from the Federal Reserve Board. Came out in the first week of February, and it does suggest, as a 9-month lead indicator, that we could be seeing some margin pressures by the fourth quarter. And in that sense, some of the expectations, for example, 10% earnings growth for the fourth quarter might be a bit too high.
Finally, Tobias, not that it hits a little close to home, but Citi's down 4%. A lot of these financials are at the bottom of a 3-month range. JPM's might break 100. I mean, do you buy financials here?
So we've been wrong on the financials. We thought it's a better place to be in the market. Part of this has been the yield curve flattening that you were talking about. A lot of people look at net interest margin in that area. Our sense is that lending activity, particularly business lending activity, will be picking up as the year progresses, and there's more spread in there. But thus far, we've been wrong. No comments on my employer, because I'd like to stay employed.